How you guys doing? Welcome back. Today's lesson 41, short-term versus long-term goals. We've actually discussed this briefly in our last lesson. Today we're going to be discussing the pros and cons of the 4 types of long-term investor or trader that you can be, whether it's going to be active, passive, speculation, or of course retirement. Some pros and cons, not much charting is going to be needed. There's just going to be a nice conversation we're going to have about that. And then afterwards, we talk about short-term goals for 10, 15 minutes. Again, just rehash. Hey, with short-term goals, we're talking about this, and this. Possibly show some charts if it's applicable, and then move on to our consistency piece and just wrapping up some loose ends. What's so great about this is that it's different for everybody. Everyone has different types of goals, different types of, life stages. And with, a 17 versus a 55-year-old, most conversations are not going to be the same. This goal setting one applies to everybody, which I really enjoy. So that being said, I want to talk about active, passive, retirement based, and of course speculation, the pros and cons thereof in those 4, and what you should be focusing on in my opinion throughout them. Once we're done with all that, we're going to put on our final side of the wall here. So we can see it's looking pretty good, but we got to add one more wall to it, and then the roof at the end, the cores, and you'll have your whole entire structure and rules ready to go. With that being said, lesson 41, long-term versus short-term goals. Let's get into it. So the first type of long-term goal you should be looking at is if you want to be an active trader. Now again, active trading is what a lot of folks like to do when they first get into this, hands-on, checking the portfolio every single day. They're into it, they're on it. They're hands-on, they activate their own trades, they exit, they enter, they have strategies, all these kinds of great things. How long is this going to last? How long can you do it? How long can you be successful with it? Well, it's all up to you. But here are some great pros if you want to be a hands-on type of investor. Firstly, there's very little surprises because you can do it yourself. There's not really going to be a, oh, that's a fee I had to pay type of moment. Now, when it comes to a hedge fund or like someone who does it for you, the word hedge fund implies it's a hedge against the market. They hedge against negativity. You can check the numbers. 9 out of 10 hedge funds, most years do not beat the market. But on red years, they really only lose 2 or 3%. They're really good about not having that much downside. So, with that being said, you also have to pay them commission fees. There's probably transaction fees. You don't know where your money is actually going. You could get stuck in a Bernie Madoff kind of situation, or like an ARC where you went and bought at the top and now it's down mightily. You never truly know. But when you're active with your hands on it, yeah, it's way more front-loaded work. It takes years to really know what you're doing. But at that point, there's no commissions. If you're working out of a 403b, Roth IRA, 401k that you do get to control in some aspect, there's not much taxes being taken out. There's a bunch of great upside to actually investing by yourself and being active. What's also great about being an active investor is that you are the one who decides where it goes, your time horizon, what you get to invest in. You could do XLK stocks and tech, XLV and healthcare. You can get some utility stocks. It's really up to you. It's pretty fantastic. The second thing that's a great pro to being an active investor I talked about is there's no fees. I mean, there's going to be some fees with like Webull or Robinhood, maybe occasionally. There's really none at this point, but there's going to be taxes taken out. There's going to be some stuff like that. But for transactional fees and just having someone do it for you, there isn't any. As I mentioned before, what the statistics show is that most hedge funds or folks who manage your money for you take 17.8%. And if you're already paying, I think on average, the average American pays 18 to 22% in taxes on their income. That's after they get paid their paychecks. You got income tax. You got to pay taxes on buying goods and services. 17.8% after you pay taxes to invest is a lot of money. Or so you get $100 in work, they give you $80 after taxes, and then you invest all that, and the guy who makes you money takes another $17.80. It really starts to add up. When you do it yourself, that's not going to be a problem. That's fantastic. The third pro of active investing is that's a skill that you can get better at. A lot of skills are fantastic, like cooking, sewing, snowboarding, skiing, carpentry, whatever it is. You can get better, and when you get better at something, you can sell it on Etsy. You can get better healthy snacks. You can save money by cooking, or in this case, you can make more money with investing. Everyone starts off at a bad investor, a bad trader, and eventually after a year, 2 year, 3 year, you get better every single day. As we say here, right on this channel, every day if you get 1% better, you get 37 times better over the year with compounding interest of your skill. So It's a great skill to have. I wouldn't rely on someone entirely. If you have 2 accounts, a trading one and a long-term one, and the long-term one's with somebody else who manages for you, that's fine. But if you do have a skill you want to get better at, trading allows you to have that, it's pretty fantastic. And then fourthly, the fourth pro of having an active portfolio that you manage is accountability. I mean, you would hate to be part of like Melvin Capital. It's 2022. They just got destroyed by GameStop. They just got destroyed by Facebook earnings. You hate to be an ARK buying at 60. Now it's at like 30. You never know, right? It's always great to have some form of accountability. If someone else loses your money, there's no accountability. You don't know who did it. There's no responsibility. When you make the money and lose the money yourself, there's built-in accountability and responsibility. If you go back and watch that mental analysis episode, that's huge to know that you're the one making the actions, you're taking on the risk, and you've done it, right? This to me is super slept on as an idea that taking responsibility in trading is a massive thing. As someone with tattoos, piercings, and not always had the greatest like, hey, it's all on me attitude in my life, having some form of accountability and responsibility through my business here and through just trading in general has been extremely useful in my everyday life. I think it applies here greatly. Now, there are some cons to being an active investor. It's like a double-edged sword, right? I remember there was a great saying when I was growing up. I actually went on some wilderness trip and we had a stick, right? This normal little stick here wood. It says break off the left side. And you break it off, but it's still there. So you break it off again, and it's still there. It doesn't matter how good of a trader you are or how great you may be, there's always going to be some con or some downside to everything you do. It's like opportunity cost. You may draft the best player first overall. You may have hit it, but again, there's still 59 players after you couldn't get your hands on, right? There's always gonna be opportunity cost. There's always gonna be a downside. So the first con to active investing is exhaustion. It's really important to understand when it comes to trading and investing on your own is that there has to be a limit of what you can and can't do before it turns into being monotonous and counterproductive, right? If you're going to be constantly watching your portfolio every single day of the week and you're planning on having 30-year long-term holds, we're talking 10, 11,000 days of checking the same stock if you do that every single day for 30 years. That's just undoable. It makes very little sense to me. So this can be a huge con or a pro. If you actually know how to actually have responsibility and trust your actions, put OCO brackets, put alerts, and let the bad boys do their thing, it's gonna be just fine. But again, it can be very exhausting with checking earnings reports, checking the markets every morning. If you sleep in on a Tuesday and the markets crash on that Tuesday, you're gonna have a bad time, right? So make sure you have exhaustion and know when to stop, right? Second con is what is the longevity of this market. I think a lot of folks have said, and now in 2022 it is kind of tapering off, but a lot of folks have said, hey, since its inception, the S&P is up like a 1.3 million %, which it is. If you were to compound the interest, it's up a bunch. And every 900 days we have great bull markets, but what's stopping the S&P, the NASDAQ, and all that from crashing down 30, 40, 50% and taking years to recover, right? So you're gonna be an active investor. Do you have the wherewithal, the accountability, the skill even to just go from short-term holds to long-term holds to doing nothing? So how long will this market last? How long will this be even doable for a retail trader? No one truly knows. A lot of folks say, well, it'll be good for the next forever for now, which, sure, but who knows how long it's going to last? So you got to make sure you have that in the back of your mind and your back of your mindsets that you have to be able to be on a swivel and move and adjust accordingly because we never know what the markets are going to do. You're a good boy. The third con is mental analysis. Just like with the first con of being exhausted sometimes, it can be a great pro, but I think for a lot of beginners who are watching this course, mental analysis can be a huge con. You never know when to stop, you never know when to start, you never know what the macro markets are doing. Do I use the industry, the sector, the index? Do I just do nothing? What do I trust myself? What's the responsibility here? Mental analysis starting off is a massive issue that a lot of folks don't understand. Going from an employee mindset to an investor mindset takes months, takes years. So again, it's just like that surfer analogy. Sometimes the best trade is none. Sometimes when you go out to go surfing or you go on vacation, go to the beach and it rains all day, well, you can't go to the beach that day. Don't do anything, right? So I think mental analysis needs to be a key through this. And as you learn more, as you get better, always reflect, take notes, and keep yourself accountable. That's what's important. The fourth con, and again, it's a toss-up. How long could you possibly do this? There's there's a bunch of folks who start off day trading. They do great 10, 20, 30 years of actually being an active investor and trader. And